All right, everybody, welcome over to the screen share. And we're at my computer terminal now. Of course, this is Coach Chris. And as you can see here, the first topic of the 8 banking principles we are going to be learning about over the course of our series here is the closed-end loans. So here's a little bit of a quick preview here as we get into it. And these are the topics we're going to be looking at as we go forward. But today's topic is the closed-end loan. And this is also what I'm calling the problem. Now, yesterday we mentioned that there were 75,000 families that had benefited from this particular product provided by United Financial Freedom. And we're not going to be talking about the product today or the solution. We're only going to be talking about the problem. But the reason I'm bringing up the 75,000 people who've benefited from this service is it's literally only 1/1000th of the people who need this help. In other words, there are 75 million plus mortgages in America today, and only 1 out of 1,000 people has been able to reverse the bank's profitability. But that's another topic for another day. So what is the problem? Why is a mortgage a problem? Why is a car loan a problem? Why is a student loan a problem? Well, obviously, you have to always make your full scheduled payment. Even if you sent in something extra, you would still have to send in the next payment. You already knew that. Now, also on a closed-end loan, such as a mortgage, you can only make payments in. You can't take out a withdrawal. And don't talk to me about a refi, because a refi is killing one loan and starting a new one. So a closed-end loan is like a black hole in space. It can only take things in. Nothing ever goes out. So the other thing about a closed-end loan is it's on something called an amortization schedule. And since that hurts my face a little bit every single time I have to say it, I also call that the bank's plan. Now I'll give you all one guess who the bank's plan is good for. Think about it. You already know. That's right, the bank. So the bank's plan is one that is going to allow them to get the maximum amount of profit. And you know what? There's nothing wrong with that. But I'm pretty sure that you'd rather have that profit in your pocket. So we're not here to say that banks are bad. We are here to say that we want to be like a bank so that we can make money like a bank. So on the closed-end loan topic here, the other issue is if we borrowed, say, $200,000, maybe this was at a higher interest rate. The highest I've personally seen is 7%. But at this 6% interest rate here, you can see that a $200,000 loan is going to turn into a $431,677 loan. In other words, you're going to end up paying for that house twice at 6% on a 30-year amortization. I'm going to show you 4% here in just a second. And plot spoiler, even 2.5 or 3% is not much better. The real issue is what you think you're paying in interest is not what you're paying in interest. So on the mortgage that we're looking at, we made a $1,200 payment and a little less than $200 went to principal, $199.10. The other $1,000 went to interest. Now, gang, I have to admit, I've been a financial advisor for a long time, so I've kind of gotten used to math, but I was a lit major in college, not a math major. So I just want to double check. 6 isn't very close to 83, is it? That's just a little bit of sense of humor there. But the point is that this quote, air quotes, 6% loan is actually 83% going to interest in the first month. And if I move this all the way forward to year 5, you can see that in the interest column where my pointer is, 931.88 is just not a heck of a lot less than 1,000 going to interest. In fact, I broke out my calculator and did the math. That's 77.7% still going to interest 5 years in. So if we roll this forward all the way to 21 years, we're more than 2/3 of the way into the loan before we get to the halfway point on paying it off. You're not seeing those numbers wrong. You're looking at it right. You've paid $300,000 on a $200,000 loan and you still owe $100,000. That's right. You paid 3 on 2 and you still owe 1. Wait a second. That must be the new math they're teaching the kids in school. Again, just a little joke, but the reality is it's actually the old math that the banks have been doing forever. Now, granted, that was at a 6% note. Well, here's a 4% amortization. The first payment that you make on a quote 4% AM note is 69.26% going to interest. 5 years into it, still almost 64%. Your 4% note, 10 years into it, you're paying almost 56% of interest. And even halfway into that loan, you're still paying 46 cents on the dollar on what's supposed to be a 4% loan. Huh. How they figure? That's what's called a rhetorical question, meaning you don't really have to answer that. But it is the bank's plan, and they've been getting away with it for a long time. And all we need to do is figure out how to flip the script so that we can be like the bank. So stay tuned. And this is a little preview of what we're going to talk about tomorrow with interest cancellation. So come back tomorrow and we're going to go beyond the problem and we're going to start getting into the solution. So this is Chris McFarland signing off for today. We'll hope to talk to you tomorrow and we'll get into what we can do about the problem, how we can fix it. Happy Tuesday, everybody. Take care.